Good morning, welcome. Thank you for joining us for this webinar today. We're really excited to get started. Just a couple of housekeeping items. If you look in the Q&A section, you'll see that I've published a couple of announcements. My name is Sarah Campbell, by the way, apologize. But you'll see that there's a couple of announcements there just discussing that this is the first of 4 parts to our tax planning series that will be going for the next month, and it has a link to next week's webinar, which you can register for there. And then I've also posted a link in case you would like to start receiving emails about future presentations and any upcoming tax dates and deadlines and other accounting topics as well. So go ahead and check those out. I'm going to go ahead and introduce our presenters. We have 3 presenters for this webinar today. We have Jill Corrigan and Katie Lloyd and Tim Larson. They'll be presenting in that order as well. Jill is a tax supervisor with Squire. She specializes in individuals, estate, and not-for-profit tax. She is CPA and graduate of the University of Utah. Katie joined Squire's team in September of 2019. Previous to Squire, she was an income tax auditor for the Utah State Tax Commission. She has experience with partnerships, corporations, and individual tax returns. Tim is a tax and business advisory partner with Squire. He helps our clients minimize their tax obligations and maximize profits and efficiencies. He and his wife, Elise, have 9 children and 25 grandchildren. He has served on several national and local tax advisory boards and was appointed by Governor Herbert to serve as a member of the Utah State Tax Review Board in 2014 and served on that board until the end of December of 2019. Thank you to all for being here to present for us, and I'm going to go ahead and turn it over to Jill to kick off the presentation.
Thank you, Sarah. Can you hear me?
Yes,
Great.
Loud and clear.
Great. Okay, good morning. Welcome. Thank you for joining us. Today's presentation provides an overview of some of the most significant tax law changes going into effect this year, as well as other key tax provisions you need to be aware of. To take advantage of all available breaks, you need to be aware of some major changes under this year's CARES Act, last year's SECURE Act, and the 2017 Tax Cuts and Jobs Act, the TCJA, that still impacts tax planning for today. So while the TCJA generally reduced tax rates, it also reduced or eliminated many deductions. The CARES Act, however, has enhanced a few deductions, and it is possible more tax breaks could be enhanced before the end of 2020. Further, there may be potential for changes next year that could affect 2020 planning. So let's get started on 2020 individual tax planning. As mentioned, the TCJA reduced income tax rates. The 7 tax rate brackets for 2020 are shown in this table for singles and for married filing joint taxpayers. The capital gain tax rates also changed under the TCJA to 0, 15, and 20%, depending on taxpayers' filing status and taxable income. The topic of investment planning for individuals will be covered in a Squire webinar in a few weeks. For individuals, identifying areas for reducing or deferring income may result in multiple tax benefits. This is because of several deductions and credits I'll be covering today are income sensitive and subject to adjusted gross income or AGI phase-outs. So if you are working for an employer, consider the immediate tax savings of employer-provided benefits such as 401k plans and flexible and health savings accounts. Other avenues for reducing income include utilizing tax-efficient investing and tax-effective retirement options. These tax planning topics will be covered by Squire's tax planning webinar series over the next couple of weeks. So let's start with a major change that came about, which was the standard deduction. Standard deduction amounts for all income categories were significantly increased by the TCJA, as this table shows. The standard deduction increase came in conjunction with the loss of many itemized deductions. As a result, many taxpayers who previously itemized their deductions may now find it more beneficial to claim the standard deduction. So let's talk about the standard deduction versus itemizing. For taxpayers who have the ability to control the timing of expenses eligible for itemizing, a way to maximize their benefit is through a technique known as bunching. Bunching is a strategy whereby deductions are clustered into one tax year when they provide the most benefit. The standard deduction is then used in the non-bunching years. So if your annual itemizable deductions are close to exceeding your standard deduction, it's not too late to make 2020 a bunching year. Here are some ways to accelerate itemizable deductions. For the medical expense deduction, recall that medical expenses become deductible once they exceed 7.5% of AGI. If you can clear this hurdle, consider maximizing elective medical, dental, and vision procedures, as well as other services and purchases. For the state tax deduction, this category of deductions includes state income tax, property tax, and real estate tax, and sales tax. The TCJA limited this deduction to $10,000 or $5,000 for people who are married filing separately. If your state taxes have not met the $10,000 threshold, consider prepaying your state income tax before December 31st, 2020. For the mortgage interest deduction, if it makes sense, make the January mortgage payment in late December to capture interest paid in 2020. For charitable contributions, this deduction provides taxpayers with the most flexibility. A strategy is to delay a year of charitable giving, then giving double the amount in the bunching year. For example, give $30,000 every other year rather than $15,000 every year. The CARES Act expanded and enhanced charitable giving for 2020. For taxpayers taking the standard deduction, up to $300 in 2020 cash donations to qualified charities can be deducted. For taxpayers itemizing in 2020, gifts to public charities is now 100% of AGI. Because of this provision, making large cash donations this year may be beneficial. Please contact your tax advisor for the most tax-efficient way to give. The TCJA also expanded tax credits for families through 2025. However, several of the credits are subject to the income-based phase-outs I mentioned earlier. The child tax credit was doubled to $2,000 and can be claimed for each child under age 17. Added was the $500 family credit for dependents other than a qualifying child, such as a college-age student or an elderly parent. For 2020, the adoption credit is still available at $14,300. And lastly, if a taxpayer qualified for the economic impact payment for a child under the CARES Act but didn't receive it, a credit may be claimed for it on the 2020 tax return. There are tax breaks for taxpayers paying for dependent care. First, there's a tax credit for dependent care expenses paid for children under age 13 or other qualifying dependents. The credit is generally 20% of the first $3,000 or 20% of up to $6,000 for 2 or more children. Also, taxpayers may take up to $5,000 in pre-tax contributions to an employer-sponsored flexible savings account for dependent care expenses. However, a tax credit cannot be claimed for expenses reimbursed through the flexible spending account. Regarding funding for a family member's education, consider making contributions to qualified tuition programs such as a 529 plan and Coverdell Education Savings Account. While contributions to these plans are not deductible, the funds are allowed to grow tax-free. Also, look into the various secondary education credits and deductions, such as the American Opportunity Credit and the tuition and fees deduction. Finally, the CARES Act provides tax relief for taxpayers with student loans. In addition to the existing student loan interest deduction, an additional tax break may be available. Employers can provide up to $5,250 toward employees' student loan payments on the tax-free basis in 2020. However, you cannot take a student loan interest deduction for any loan payment for which the exclusion is available. So that is it for individual tax planning. We'll move next to Katie Lloyd for planning for businesses.
Thanks, Jill. And I'm excited to talk about some of these items. A lot of them are going to be high level, and so if you have any questions, any deeper questions, feel free to post them in the chat or follow up with us later on. We'd be happy to help. So the first thing I want to talk about is the business structure. Good, thank you. And just some really straightforward differences between pass-through entities and sole proprietorships versus a C corporation. And probably the most common one that most people know is there's only one level of taxation with the pass-throughs. All the business income is passed directly onto the owner. However, with the C corps, the business is taxed at the business income level, as well as to the shareholders who receive dividends. The next difference is the tax rates. The pass-throughs would be taxed at the individual tax rate up to 37%. And C corps, it's a flat corporate tax rate right now at 21%. Tim will talk later on potential changes with Biden's proposed plan, or depending on the election and the tax law changes in the future, it could be up to 28%. And the other major difference is pass-throughs are eligible to receive a 20% deduction on qualified business income, which I'll talk about in the next slide, and C corps aren't allowed to receive this deduction. It's only for pass-throughs. So that 20% deduction, it's the Section 199A deduction, and that is up to 20% deduction on qualified business income. And qualified business income would be activities that are considered trade or business. And this it is subject to taxable income thresholds. For 2020, the threshold is $163,300 for individuals and for single taxpayers, and it would be double that for a married filing joint. And if your income is above that threshold, then certain service trader businesses may also be excluded from that deduction. Businesses such as service industries like lawyers, CPAs, etc. So you want it, and the next slide kind of walks you through what type of business would qualify for the deduction, what thresholds you're at. The numbers, I believe, are for 2019, so just to keep in mind, but these slides will be available later, and I don't want to dive into this, but just as a useful note for you to look over later. And the next thing I want to talk about is the projecting the income. I kind of walked through 4 steps, just really basic ones to think about when looking at tax planning. Is you first kind of look at your business income for the current year and for the next year. And by doing that, you can see where your income levels are at and if you want to increase or defer tax, or increase or defer income essentially, or expenditures. And to get a better idea of looking at your tax brackets and where you want to be. So that would be the second step. And third, once you've decided if you need to defer or accelerate income, you can look at the different strategies. Some of the most common for a cash payer, if you want to accelerate or defer income, would just delay sending out bills, or the invoices, or as well for the expenses, you would just delay paying those. Or if you want to increase your expenses for the current year, then you pay them quickly or pay it with a credit card. And then the last thing is step 4 is just review your whole business objectives. Because if you just look on the tax side, you might be overlooking your cash flows. You might be overlooking your customer satisfaction. If you're delaying revenue, you're delaying shipments. Are your customers going to be happy? So even though you want to look at your tax planning and you're projecting your business income, keep in mind your other goals as well. The next item I want to talk about is depreciation, and don't want to talk about everything on the slide just for sake of time. But just as a recap, depreciation is for assets that are purchased that have a useful life over a year should be capitalized and depreciated over time. The most common method is makers, and that's because you have a larger deduction in the earlier years of an asset's life. But beware of if you have purchased over 40% of the assets in the last quarter, then you'd be subject to mid-quarter convention rules. Section 179, you can deduct the cost of new and used assets up to a limitation of $1.04 million. And there's a bonus depreciation, which currently it's 100%. That will start to be reduced in 2023. And this was from the Tax Cuts and Jobs Act. And that's for assets with a recovery period of 20 years or less. And the one thing I did want to point out specifically is qualified improvement property. Thanks to COVID, the CARES Act made a correction to make qualified improvement property with a 15-year useful life. So that means it is now qualified for bonus depreciation. So, and that is actually effective from 2018 and 2019. So you may want to consider looking back in 2018 if you had any improvements, if you want to go back and amend and claim bonus and receive a refund for those years. There's vehicle-related depreciation available, subject to limitations as well. And also keep in mind that with vehicles, if you need to make sure if you want to claim makers or Section 179, you want a business useful life or business use percentage to be over 50%. And next is the meals, entertainment, and transportation. With the Tax Cuts and Jobs Act, they removed a lot of the 100% items that were deductible for meals. So items that are business related on the employer's premises and at the convenience of the employer are now cut down to 50%. You can still include 100% for holiday parties or company picnics or any meals that are included on the W-2 of the employee. Entertainment is no longer deductible, and transportation still can be deducted as long as it meets certain rules, but they did do away with transportation expenses can be deducted for fringe benefits such as parking. And we would recommend that we still see very often that meals and entertainment is still grouped into one single account on the chart of accounts. Recommend that for sake of audit protection and ease of doing the tax work to break out those accounts, to break out your meal accounts that have from 50% to 100% items, and also break out entertainment from meals. That's the best practice you can start implementing. Next, and as an employee benefits, it's always nice to look over that what you're offering your employees, as it will make your employees happy offering these plans. And also there are tax deductions for the employer on contributions that are made on behalf of the employee. I don't want to really dive into this. It will be talked later on in a different webinar, the different retirement plan options and the HSA plan options. So there's some useful information on this slide deck and also in the tax planning guide, but I don't want to take time right now. Look for a future webinar to talk more about it. The next slide is on the business tax credits. And some of these might be familiar, but the first one is the research credit, and that would just encourage investments in research. And something that you may not be aware of is certain startups can use this credit to offset payroll tax. And so it doesn't necessarily have to offset your taxable income, your income tax, but the payroll tax for the employees who are doing the research. And it could be very useful. And the next three, the work opportunity, new markets, and the family medical leave credit, I wanted to point out that those are scheduled to expire at the end of this year. So if you think you are, is this something that your company would take advantage of to look at right away? Take advantage of it, and who knows with everything with COVID if they might expand the credits, especially the family medical leave credit, as a lot of people will probably be taking use of this one. It's you can claim a credit for the % of wages that are paid to your employee during family medical leave. So especially that one, make sure that you consider that in your tax planning for 2020. Ask your tax preparer, talk to one of us at Squire, as a lot of people are probably using those wages with everything with COVID going on. And so the next slide is on self-employment deductions. Just wanted to talk about these as a self-employee, if you have self-employment income, these are all deductions that would be above the line. In other words, you don't need to itemize, as Jill explained in her presentation. They would all decrease your adjusted gross income. And the self-employment tax, it's at 50% of the employer portion. And the health insurance cost would include your cost as well as your family, which is 100% above the line deduction. There's above the line deduction for retirement and HSA plan contributions, the health savings account. And the home office is also a deduction, and just remember that it's only for self-employment income. So there may be a lot of employees now, W-2 employees, that are working from home and have set up a home office, but this isn't for them. They can't claim this deduction. It's just for the self-employment income. And lastly, I just wanted to mention some of the changes from the CARES Act. So these changes came about from the Tax Cuts and Jobs Act, but CARES came back and kind of helped them out with these different changes that were made. So there was an interest expense deduction for the businesses that have high gross receipts. It was 50% of AGI or ATI, and now it's cut down to 30%. The NOLs were limited to 80% of taxable income. It's now been removed. You can deduct up to your whole entire taxable income. They are allowing the 5-year carryback, and this is for 2018, 2019, and 2020. So again, maybe look back, see if you want to amend any of those returns and claim a carryback. And the pass-through entity excess business losses, it was limited to $250,000 or $500 for married filing joint, but those have been removed. So again, look back, maybe it's worth amending, maybe not, to claim the refund. And so, like I said, just a kind of brief overview. That's it for what we have on the tax planning for businesses. And now I'm going to turn it to Tim to talk about the election and the different tax plans.
Thanks, everyone. It's good to be with you this morning. There's a lot of things we could talk about, but there's still some uncertainty in the election, so we really don't know exactly who the president will be. It's pretty certain now that it looks like the Republicans will retain the majority in the Senate, and that changes the potential outcome of some of the Biden-Harris proposals, because with the Republican-controlled Senate, there would likely have to be major compromises in order to get any of these proposals, which we pulled from the Biden-Harris website, and are presenting those to you today. So if I had a crystal ball, I'd be able to tell you what was going to happen in the future. I don't have an accurate crystal ball. So these proposed changes are just that, proposals. It's highly unlikely that all of these will be enacted at this point, but they're still proposals on the table. Okay, Jill, will you go to the next slide then? So the main thing about the Biden-Harris tax proposal is that most of the changes that they're impacting, or that they're proposing, most of the changes they're proposing will only impact negatively those whose income is greater than $400,000. So the proposed increase is back to the pre-TCJA levels of 39.6% maximum tax rate, up from the 37% that was enacted under the TCJA. It's unclear on their website as to whether this threshold applies to individuals as well as joint filers. We really don't know that. That was kind of the dialogue during the campaign and during the when they had the debates, but we really don't know, and their website is not clear. If it applies to both, there would have to be some adjustment to the individual tax rate structure. Go to the next slide, Jill. The one other big change that they're proposing would be to completely eliminate the qualified business income deduction that Katie talked a little bit about. And this is that pass-through deduction that tries to equate the rate of tax paid on business income to the corporate rate, which under current law is 21%, and under the Biden-Harris proposal would jump to 28%. For those in the income tax brackets where their income is greater than 400% or 400,000, that would potentially increase those taxpayers' income tax by as much as 10%. Okay, next slide. Another change that they're proposing would be to limit itemized deductions. The plan would cap the value of any itemized deduction to 28% of adjusted gross income. And so those in a tax bracket equal to or under 28% would not be affected. But if you're in a tax bracket higher than that, then you would not get as great a deduction under their proposal as under current law. So for example, if you're in the top tax bracket under their proposal of 39.6%, and for every additional dollar of itemized deductions, under current law, you would receive 39.6 cents for every dollar that was included in your itemized deductions. Under their proposal, it would limit that to 28 cents on the dollar. And so we really don't know exactly how this would be enacted, but it would be some limitation on the amount of itemized deductions that could be claimed by those whose income is in excess of $400,000. Next slide. There's also in their proposal a proposed change to the way retirement contributions are reported on the tax return. Currently, they're reported as a deduction, and their proposal would be to change that from a deduction to a credit against income taxes paid. We really can't tell exactly what rate. In the debate, there was a discussion about 26% as being that rate, and that's the only information that we have on that right now. This change would be meant to incentivize those in lower income tax brackets to contribute more to their retirement accounts, and it kind of penalizes those who are in a tax bracket greater than 26% because they would not receive as great a deduction as under current law. So I've got in italics there at the bottom that the one thing you could consider if you're in that higher tax bracket is either Roth conversions or making contributions to Roth IRA accounts or 401k accounts, and forego the 26% tax credit for the benefit of tax-free income later on when you pull the money back out of those. Next slide, please. Biden and Harris are also proposing enhancements to some of the credits that Jill talked about. The child tax credit would increase from $2,000 for children under 17 to $3,600 for those who are under age 6, and $3,000 for all qualifying children between 6 and 17. And the child and dependent care credit that Jill discussed would go from $3,000 to $8,000 for a single child, and from $6,000 to $16,000 if you are paying child care for 2 or more children and both spouses are working. They are also proposing to reintroduce the first-time homebuyer credit. This would be a refundable or an advanceable credit, meaning that you could get it ahead of time, ahead of when you file your tax return. And in their proposal, the credit could be as much as $15,000, depending on various criteria. They are also proposing a new credit, which we've never seen in the law before, for a caregiver, and it would provide up to $5,000 for those who are providing informal long-term care for a parent or other relative. Next slide. This is another change that has been in the press a lot. I've seen it misrepresented in the press. The misrepresentation is that the Biden-Harris proposal would eliminate capital gain tax rates. That's not really true. What their proposal says is that if you make more, if your income is greater than $1 million, then you would pay tax on any capital gain income at ordinary income tax rate. So if you're in the highest bracket, which you would be with likely would be with $1 million of income, then you would pay tax on those capital gains rather than at the current 20%, it would be at the 39.6% level. And they would also retain the 3.8% surtax that was added to the law with the Affordable Care Act and in the Obama administration. That would remain in place according to their proposal. Another really big change is that the 1031 tax-free exchanges would be eliminated for any taxpayers with annual incomes over $400,000. Next slide. And this is probably the biggest change of all the things that they're proposing, is that they would propose eliminating the step up in basis upon the death of an individual. It's also referred to as a deemed sale on death. Most everyone whose parents have passed away have experienced the opportunity to take a step up in basis. The largest asset in most cases is a parent's home. So when they die, they receive the heirs of that estate receive a step up in basis to the fair market value of that home, so that if they sell it shortly after the passing of their parent, then there would be very little, if any, gain, because you would only measure the sales price against what the fair market value was on the date of their death. So that's a big change. If they were to eliminate that, it would apply to all inherited assets, and it would affect all taxpayers in all tax brackets. It would make it more appropriate at that point for taxpayers to consider life insurance as a way to hedge against the potential estate taxes that would be due upon death, and the tax resulting from the sale of assets that are received through an inheritance. It would also mean that you could probably do greater planning and strategically gift or sell certain assets prior to the death of the individual, so that you can control the outcome a little better than what you would receive if those assets were still in the individual estate upon their death. This is a proposal that I see as very difficult, even if the Senate were to have flipped to a Democratic Senate. I really can't see a lot of the people in the Senate and in the House of Representatives voting in favor of this, just because of the personal impact it would have on their own situations. So even if the Democrats had achieved the control of both the House, the Senate, and the White House, I still believe that this particular provision would be very difficult to pass. However, it's in their proposal, and so that's why we're presenting it here today. Next slide. This is one that's more likely to pass. It's been discussed and it was hotly debated when the Tax Cuts and Jobs Act went into effect, and that is the exclusion for estate taxes. We are currently at 11.58 million of assets that can be in an estate before estate tax would be applicable. And that is if both the husband and the spouse and the wife are still living, that's 11.58 million per individual. The proposal is to go back to pre-TCJA levels of 5.79 million. It still is outside the range of asset value for the majority of Americans, but it would impact those with higher estate values much more, at least, than the 11.58 million. And there are still ways in 2020 to take advantage of the higher exclusion amount through gifting and through other things, that if you're concerned about this going down, see your tax advisor, see your attorney, make sure you take advantage of those ways to get those assets out of the estate so that they would be preserved if there is a change in this area. Next slide. Okay, I think that's it then. So if you have any questions, I'm not sure I can answer all your questions regarding what might come to pass, but I can certainly address any questions regarding what's in the Biden-Harris proposal. So at this point, I guess I'll turn it back to either Jill or Sarah.
Okay, thanks, Tim. We'll give everybody just a few more seconds to submit any questions if they have any, but so far we don't have any coming in. And if any of you have questions that kind of come up a little bit later on after you've had some time to digest the information, I'll be sending out the slide deck, which has the contact information for Jill, Katie, and Tim. And so you can always reach out to them later on. And it looks like we still don't have any questions, so we'll go ahead and wrap it up. And we thank you guys for coming and listening in, and hopefully we'll see you at the next webinar next week on the 12th. Thanks, everyone.